Okay, let's dive right into this explainer. Today, we're putting on our expert investment analyst hats and seeing what happens when we run a hyper-growth space stock through the absolute ultimate investment gauntlet. We're taking Redwire Corporation, which is a company literally trying to define the future of space infrastructure, and we're stress testing it against the legendary, time-tested frameworks of Warren Buffett, Peter Lynch, Benjamin Graham, and modern Wall Street discounted cash flow models. The big question is, will it survive the test, or is it going to crash and burn? We've got a great roadmap for this analysis. We'll start with a quick company snapshot, then run it past the value purists, look at it through the growth lens, build a discounted cash flow model, check out the market multiples, and finally synthesize it all into a final verdict. So let's kick things off with a snapshot of what Redwire actually does and where they stand in the market right now. Redwire trades under the ticker RDW. They're a specialized aerospace and defense contractor with a $2.3 billion market cap, trading right around $8.45 a share. These guys build mission-critical space infrastructure, advanced sensors, and uncrewed aerial systems. And they are securing some massive global contracts, like a multi-year deal to deliver tactical drones to a NATO country and the Taiwan Coast Guard. The top line looks fantastic, pulling in $371 million in trailing 12-month revenue. But, there's a serious catch hiding in the financials. Yeah, take a look at the trailing 12-month free cash flow. It's a staggering negative $155.3 million. They also posted a net loss of over $300 million in that exact same period. It's a classic cash-burning, heavy investment hyper-growth profile. So how on earth do the investing legends evaluate a setup like this? Let's find out by moving to our first gauntlet phase, the value purists, Benjamin Graham and Warren Buffett. If we treat Benjamin Graham's defensive investor checklist like a strict report card, Redwire actually passes the first couple of tests. It's got adequate size with that $2.3 billion valuation, and it passes on financial condition too, holding $145 million in cash against a very manageable $132 million in debt. But right after that, it completely drowns in a sea of red fails. There is zero earnings stability, no dividend record, and honestly, a non-existent price-to-earnings ratio. And it actually gets worse when we try to calculate Graham's intrinsic value. Because Redwire has a deeply negative earnings per share of negative $2.68, Graham's formula literally breaks. You just can't take the square root of a negative number. So for Graham, the fair price is basically zero. There is absolutely no margin of safety here for a defensive investor. Applying the Warren Buffett lens yields a pretty similar outcome. Now, Buffett would definitely appreciate the manageable debt load, and he'd respect the economic moat they're trying to build in specialized defense and space infrastructure. He also likes honest management with skin in the game. But as we know, Buffett demands consistent earnings, a high return on equity, and positive owner earnings. Redwire's ROE and owner earnings are deeply negative right now. Without those predictable cash flows, Buffett's criteria trigger an immediate, hard pass. But wait, let's flip the script. What happens if we view Redwire through the growth-oriented lens of Peter Lynch? Lynch loved categorizing companies, and he would absolutely peg Redwire as a fast grower, or maybe a turnaround. Fast growers are those aggressive enterprises expanding revenue at 20 to 25% a year. Redwire's top line has grown at an average annual rate of 27.6% over the last 3 years, and they just grew quarterly sales by an incredible 58% year over year. For Lynch, that is exactly the type of aggressive top-line expansion that leads to massive multi-bagger returns. And this number right here captures that growth narrative perfectly. They have a massive $498.1 million contract backlog. What's even crazier is their book-to-bill ratio is nearly 2-to-1, which means new orders are flying in the door almost twice as fast as the old ones are being fulfilled. The demand for their hardware is undeniably real. Now, Lynch also heavily scrutinized insider activity. Recently, headlines popped up that Redwire's CEO sold over 25,000 shares, but if we actually dig into the SEC filings, we see it was purely a non-discretionary sale, just an automatic withholding for tax liabilities unvested stock. The CEO still holds a hefty direct stake of 632,000 shares, which is valued at over $6 million. Lynch loves to see that kind of confidence, and management clearly still has significant skin in the game. Under the Lynch framework, this stock is definitely a speculative buy. Okay, so how do modern analysts price a company like this? Let's build out a discounted cash flow, or DCF model. Because current cash flows are so deeply negative, we are forced to make some pretty aggressive assumptions. First, based on analyst models, we have to forecast free cash flow reaching profitability by roughly 2029, where revenue is projected to cross $712 million. Second, we apply a weighted average cost of capital, or WACC, of 10% to discount those future cash flows back to today. And third, we'll assume a 3% terminal perpetual growth rate, which is standard for the aerospace sector. When we plug all those aggressive growth assumptions into a sensitivity table, our base case fair value lands at $15.67 a share. Compared to the current price of roughly $8.45, you're looking at a massive 54% upside. Obviously, if we tweak the WACC up to 12%, that value drops. But if we lower it to 8%, it soars past $20. The core takeaway: if management can actually execute their backlog and stop the cash burn, modern valuation models see immense upside. Let's step away from projections for a second and see how the market is actively pricing Redwire against its peers using multiples analysis. This perfectly illustrates the market's internal tug-of-war. Redwire trades at just 3.4 times sales. That is a massive discount compared to the 9.9 multiple of a peer like aerospace parts manufacturer HEICO. Sure, Redwire is a high-risk growth stock dealing with heavy integration costs from acquisitions, but the bulls argue it could literally become the HEICO of the space industry. If that happens, paying a 3.4 multiple today is incredibly cheap. However, looking at the enterprise value to EBITDA multiple paints a much darker picture. Redwire sits at a negative 10.4, while the sector average is a positive 12. This just goes to show that traditional earnings metrics are completely useless for this stock right now. If you're buying Redwire, you're buying revenue growth and a defense backlog. You are certainly not buying current operational efficiency. All right, we've run the gauntlet. Let's synthesize all these divergent frameworks into a final verdict. This summary right here is the ultimate clash of the titans in financial theory. The strict value models of Graham and Buffett rate the stock's fair value at absolute zero because of the negative cash flows and lack of earnings. But on the flip side, Peter Lynch's growth lens and forward-looking DCF models see a multi-bagger in the making, with a base fair value soaring past $15 and multiples looking deeply discounted compared to proven peers. So, our final blended opinion? It's a speculative buy or hold at $8.45 for growth investors who can stomach the high volatility and actually trust the company to convert that nearly $500 million backlog into profits. But if you're someone seeking safe, predictable cash flows or a traditional margin of safety, this is a strict, hard sell. What exactly would make our gurus change their minds? Well, for Buffett and Graham to hit that buy button, Redwire has to prove it can halt the cash burn and generate consistent, positive free cash flow without diluting its shareholders. But for Lynch and modern DCF analysts, the buy trigger is flashing right now, suggesting the current price inherently offers a margin of safety for the future of the space sector. We've seen the math, tested the frameworks, and mapped out all the assumptions. But the ultimate question for your own portfolio is this. When you're looking at a company trying to build the literal infrastructure of space, do you trust the rigid safety and profitability metrics of the past? Or are you willing to bet on the high-flying, cash-burning growth of the future? At what price does Redwire enter your orbit?